Hi everyone, buyer's agent Jay Pace here for Providence Property Group with a market update for the month that was October 2022. So first, for a change, let's have some nice news. Wealth grew at a strong pace in 21, and by year end, global wealth at prevailing exchange rates totaled $725 trillion, a gain of 9.8%. Wealth per adult rose 8.4% to the Australian equivalent of $136,800. Okay, so setting aside exchange rate movements, aggregate global wealth itself actually grew by 12.7% in 2021, which is the fastest annual rate of growth ever recorded. This means that we have a nice buffer against factors such as inflation, rising interest rates, and declining asset prices. Now, Credit Suisse's annual global wealth report lists that Australia, or Australians, have the highest median net worth in the world of just over $413,000 per adult. So that's thanks to soaring property prices. The median wealth per Australian adult rose by $43,000 just in 2021. Now, despite having less than 0.5% of the world's population in our beautiful sunburnt country, Australia is now home to 3.5% of the world's millionaires. On Tuesday, the 25th of October, the Treasurer handed down his first budget under the New South Wales government. So at the cost of more than $7 billion, the budget, which is in the Treasurer's words, solid, sensible, and situated to the conditions, included initiatives aimed at addressing inflation and the rising cost of living. As exciting as it would be for me to read the entire budget to you, I thought I would just skip to the highlights around property. First is affordable housing measures. So the government will establish a regional first home buyers guarantee scheme and a Housing Australia Future Fund. This is for the regional area, and this is due to the fact that regional areas hadn't increased in value really since the 1980s, if you look at it on the chart. And now, those people who actually grew up in those areas, since COVID started, they're shut out of the market. So we don't actually recommend regional areas for capital growth. Yes, it's had some great movement, but there was no data to suggest that this black swan event for COVID was going to push some people, not a lot of people, but some people out to the regional areas, and only a small increase in population for some of these small towns that have less than 1,000 people in their population can significantly change price points. Is that going to continue to happen? No, I don't think so. Population changes are the driver of growth, and these areas do not have a long-term outlook that makes us feel confident. Second, housing accord. So struck between state and territory governments and investors, including super funds, targeting 1 million new homes over 5 years from 2024. So the government will commit to $350 million over the next 5 years to deliver 10,000 affordable dwellings. So $35,000 per dwelling, 10,000. I don't know what they're going to look like, but these are likely going to be regional, and they're going to be high-rise unit blocks as well if they are not regional. So the theme for housing in the budget is always has the same rhyme to it. There's not enough housing, there's too many people, and more importantly, too many of those people want to all live in the same nice, expensive areas, but they can't afford it. Now let's talk about interest rates. Yesterday, the RBA announced another rate rise. This time, it was 0.25%. This is the second 0.25% rate rise since the RBA slowed off on its 0.5% rate increase spree that it had there for a couple months. Psychologically, this is going to reinforce the message to the market that the RBA is starting to tap the brakes on interest rates. So the old cash rate was 2.6%. We've seen now an increase of 0.25% to 2.85%. Still very, very low. A lot of buyers are sitting on the sidelines and they're looking for a sign to jump into the market. Maybe this is the RBA giving you that sign. This is the rolling 3-month change in dwelling values for our state capitals, and we can see further decline across the major capital cities. The flow of new listings started to trend higher actually in October. But traditionally, if we look at the spring selling season, this remains well below levels at the same time last year and relative to previous 5-year averages. So if you have a look here, you can see over the 4 weeks ending October 30th, the number of newly listed capital city dwellings was tracking 25.2% below the same time it was last year and 19% around about the previous 5 years. So there's not a lot of product on the market at the moment. And what does this mean? Well, in order for property prices to have this significant drop in value that everyone keeps talking about is inevitable, the number of properties for sale needs to rise exponentially. Okay? And there's no real sign of that happening anytime soon. Remember, we have record savings as Australians. We saved over $300 billion during the 2 years that the government, told us sent us all to our rooms and said you have to stay at home. We've got a lot of savings to use that as a buffer. The last thing people are going to do is give up their homes and sell. That just doesn't make sense. Now, let's take a look at the winners and losers for the month. Every capital city and state's regional area registered negative growth for the month of October. Across capital cities, the month-on-month decline ranged from as high as 2% falls in Brisbane to Perth, where dwelling values nudged down by 0.2%. Across the rest of the state regions, monthly falls of more than 1% were recorded in regional New South Wales, Victoria, and regional Queensland. And just like my father used to say to me at the end of every school sports carnival, there are no winners. But seriously, there are always markets within markets. But if you listen to the media, they won't go into the granular details needed to understand the market. And I'm short of time today, so I can't really take you through the top SA3s. There's 80 suburbs, so there's a list of top 10 each capital cities, but I don't have time. There's 80 suburbs there. So what I did is I actually took the top performing SA3 suburb in each of the main capital cities and I put them into a table for you. So Fairfield in Sydney's southwest actually increased by 4.3% this year so far. Rockingham in Perth southwest increased by 9.4%. Melbourne City increased by 10.3%. Hobart northeast actually increased by 4%. Ipswich hinterland in Queensland increased by 23% during this past 12 months. Playford in Adelaide's north increased by 24% in this past 12 months. But I know I sound like a broken record here, but it's important that we don't forget where we were just a few short months ago with our property market. The media is, as usual, focusing on doom and gloom because it sells. But according to the news cycle, the market is either going crazy good and it's just picturesque, or it's scary bad and it's just apocalypse time. There's no in between. Across Australia, combined capitals increased in value by 25.5%. The majority of these cities hit their peak in April 2022. So since that, they've basically declined about 6.5%. So this is an average. But as you can see from this chart here, some cities performed better and they didn't start declining till much later than April, and others started their decline earlier and they performed much worse. All of this reinforces our philosophy of being a borderless investor. Okay, let's have a quick look here. Now it says COVID through to the peak. I would classify COVID realistically from April, May 2020, which is when we realized that this is real. Okay, and you can see there Sydney increased by 27.7% during that time. And then in January 2022, we started seeing a decline in prices, and it's down about 10.2%. Melbourne up 17.3%, which is actually the worst performer out of all the capital cities. Why? They were the most locked down city on the planet for quite some time. They're currently down 6.4%. They started their decline in February. Brisbane up 42.7% from COVID. Okay? Geez, if only a buyer's agency company told people less than 2 years ago that they should be buying there. Oh, wait, that was us. Now they're down 6.2%, and that only started in June. Adelaide, 44.7%. Now they're only down 0.6%, and that started in July. So still a really good performance there. Perth, 25.9% up. Now they're down only 0.7% since July. Hobart, 37.7%, down 5.7% starting in May. Darwin 31.1% up, only down 0.9% starting in August, and the ACT Canberra up 38.3%, down 5.4% since June. So at Providence, we focus on two main strategies: growth and cash flow. Now, both strategies are part of a healthy portfolio, and as you can imagine, our clients are heavier on capital growth to a certain extent in some cases, and right now they're trying to balance those scales out by using the high cash flow strategy. So what I wanted to show you today is what we're doing for some of those clients that were always about, Jay, buy me land close to the CBD, which is part of our growth strategy. But some people kind of ignore the high cash flow. And I think now is a time that's really highlighted the need for that strategy as well. We do also have some clients that only focus on high cash flow when we tell them they should be diversifying with also capital growth. But I wanted to just explain to you a little bit more about this particular strategy. So when people purchase an investment property, they want peace of mind knowing that the property can pay for itself to a certain extent, okay? Lower out-of-pocket serviceability costs result in longer holding of the property and better exposure to growth in the long term. So today I'm just going to give you an abridged version of our high cash flow strategy and a real example of something I bought for a client only recently. So we're hunting rental yield in this strategy, and I'm going to break down the numbers very quickly. So the national median dwelling value is $730,000. Unit, townhouse, house and land, $730,000 across the nation, okay? Now, the nation's median rental yield is 3.6%. In Perth, where this example that I'm going to show you is situated, the median rental yield is 4.5%. Now that's 55% higher than Sydney at 2.9%. So you can see why this is attractive from a cash flow perspective. In Perth, the median dwelling value is $559,000. On a house, it's slightly higher at $585,000. Now we identify suburbs all over Australia that meet our strategy parameters, and then we assess properties that meet our purchasing criteria. So let's look at the market trends for this suburb, and I'm not going to give it away. You don't get everything for free on this channel. You need to call me and we have to have a chat. But I wanted to show you this suburb where we purchased this example in. CoreLogic estimated the value of this property at $370,000. The median for the suburb is $380,000. You can see that this particular suburb has actually had an increase of 20% in the last 12 months, and properties are on the market for only about 7 days. So in this suburb, over 22 properties are purchased or sold, whichever way you want to look at it, every single month. And also the long-term growth, you can see it's done 3.98% over the past 5 years, which is 7.96%, which is pretty good. Next, we're going to look at the vacancy rate, because people always say, yeah, Jay, but can you rent it out? Well, we're not buying in, regional mining towns or anything crazy like that. This is, within a 50-kilometre radius of the CBD. And that's not so crazy considering within a 50-kilometre radius of Sydney CBD, houses are selling for over $1.5 million and making people less than 3% rental yield. Now, the vacancy rate in this suburb is extremely tight, 0.4%, which is a balanced market's 3%. Anything above 3 is potentially oversupply. Anything below 3 is, high demand. So here's the property. We purchased this recently for $360,000. So we did a bit of negotiation on that. It's a 680 square meter corner block. Corner blocks are my unicorns. I don't always catch them, but every now and then I can get one. The property is less than 40 kilometers from Perth CBD. It's within WA's largest regional city. It's 250 meters from a hospital with over 200 beds across 18 hectares, less than 1 kilometer from the train station and local shopping village, and also less than 1.5 kilometers to a major shopping center with almost 200 specialty stores. So it's not just a small little shopping center, it's quite a big Westfield style shopping center. Now, it's a typical 1980s early build, okay? The tenants are quite house proud, and they've taken care of the place. So we were really happy when we got in there and we assessed the property itself. Now, one of the major selling points, as I said, about this property is that it's a corner block. So our team has reviewed the yard, and we are able to actually put an additional dwelling on this in the future if we want to, with its own street front driveway access, which is really attractive. Okay, again, this is us not only doing a high cash flow strategy, we're supercharging this high cash flow strategy. You can see the houses around it. These are typical suburban houses. They've got solar panels on there. They're young, nice roofing, etc. Some of them got pools. Like, this is a nice urban area. Now, the design of the granny flat, if we decide to put that on there for the client, this is a standard design, 2-bedroom, bathroom, laundry, kitchen. You can either do a carport or an alfresco area there on the right-hand side. Really attractive. This is a photo of one that one of our clients has done early this year or late last year, I'm pretty sure. And, living dining room, really attractive, open plan kitchen, alfresco dining area, large bedrooms, bath, shower with double sinks there. And here's a closer look at the numbers. So let's forget about the granny at the bottom. Okay, the primary residence that we bought for $360,000 or $10,000 under valuation, and it's earning $450 per week. Now, I'm being conservative with my rental yields because there is a rental crisis going on right now, and I'm buying properties for clients, the whole team is, and by the time we're actually settling on those properties, the rent has increased quite significantly. But let's call it $450 per week, which is a 6.5% rental yield, okay? So that means you're receiving 6.5 and you're maybe paying 5% in interest. So this is a positively geared property. The total cost of the granny flat, if we do build it, is between $180 to $200, let's call it $190. And it's earning $300 per week. Again, that's conservative. Now that would give you an 8.2% rental yield. So the total yield across the two properties is 7.09%. Every single person should have a property like this in their portfolio so that when capital growth is not happening in your portfolio, rental yield is pushing. And when people are scared about buying property in the market, those people that would have moved from being renters to being owner-occupiers stay in that rental pool, meaning that rent demand increases even more. So in summary, we purchased this property at 5.26% below the suburb median value, and we will be receiving a rental yield 61% above the average house in that particular capital city. Okay? Enough about Perth, let's talk about Southeast Queensland. And I've been getting a lot of questions asked about this recently. So our research started us buying in Southeast Queensland, in the Brisbane area in 2014. And the performance has been amazing. There's no other word to really describe it. There's a lot of great buying still in the region, and we plan on continuing to achieve above average results for our clients. Now, our friends at McGrindle put together this really funky looking infograph on the future of Southeast Queensland. I'm going to share some of it with you because I think they did a really good job here. Go visit their website. They've got some great stuff. So Southeast Queensland is a key region within Australia, supporting the economy and contributing to a thriving nation, with Brisbane getting the 2032 Olympics and Paralympics ahead of the development and the growth that this is going to bring. Understanding that landscape of SEQ towards 2050 is really, really important. So Southeast Queensland's population is projected to increase to 5.9 million people by 2050. So that's a growth of more than 2 million people over the next 30 years. By 2050, almost 4 in 5 Queensland residents, 79% of them, are going to have to live in Southeast Queensland. That's where they're going to be. Now, housing across Southeast Queensland is also projected to grow and change with the population. So this growth will primarily take place in semi-detached housing. The low-density housing composition of Southeast Queensland will definitely shift to accommodate what is currently called the missing middle. So that's people that were in houses or within units. They want to upgrade. Houses are a little bit too expensive, so they're going to townhouses, which is that middle density style type product. So semi-detached median density housing is projected to account for 18% of households in Southeast Queensland by 2050. And that's an increase from its current level of only 12%. And high density flats and apartments will also continue to comprise about 16% of housing. Okay, so they're not going to increase as much because over the years there was a little bit of an oversupply of units. Now, standalone houses will make up 2/3 of Southeast Queensland dwellings, so 66%. And that's going to decline though from 71% because, as I said, everyone wants houses, but they're getting too expensive to buy or hold. So people are moving into townhouses. And this is a similar journey of that Sydney and Melbourne saw over the decades. Now, I often hear people say to me, if I only had a time machine, I would have bought earlier. Data is your time machine. Unless you truly believe that we are in a massive, or at the doorstep of a massive global financial crisis that will completely change life as we know it, what are you waiting for? And I know that you don't believe that, no matter how much you're telling your friends about it or reading it in the newspaper, because you wouldn't be watching this video. Instead, you would be digging holes with this bloke, and you would be getting your canned peaches and your doomsday prepper kit all ready. But you're not doing that. So let our professional buyer's agents help you. For almost 2 decades, Providence have helped Aussies locate, assess and negotiate their ideal home or investment property Australia-wide. Stop procrastinating, contact us today. If you like what you've seen here and you want to be kept in the know with the Australian property market, make sure to like this video and subscribe to our channel. If you'd also like further education, you can download our ebooks. The links are in the YouTube description below. And I want to thank you for your time today, and we will see you next month.